Accrual basis of accounting versus cash basis of accounting. Let's take an example. Mr. X sold an assets to Mr. Y for $10,000. Here, in cash, $6,000 and on credit, $4,000 in condition. If they record this transaction in $10,000, it's called accrual basis of accounting. Accrual basis of accounting means where any income or expense is recognized when it is earned or incurred, irrespective of the time when it is paid or collected. On the other hand, if they record this transaction in $6,000, it's called cash basis of accounting. Cash basis of accounting means where any income or expense is recognized only when there is an inflow or outflow of cash. The key difference between the accrual and cash methods relates to the timing of revenue and expenses, when they're earned or incurred and when they're received or paid. The accrual basis of accounting is the prime standard because it gives a more truthful representation of a company's finances. With accrual accounting, businesses can simply keep track of credit transactions using an accounts receivable system, which shows the full transaction history of each customer. GAAP-compliant accrual accounting is required for companies of a certain size with certain debt covenants or that are publicly traded. A weakness of accrual accounting is the extra bookkeeping. It also needs more frequent closing of the company's books. Many businesses favor to use cash accounting because the financial statements closely reflect their cash position, which is particularly important for small business owners. The simplicity also makes bookkeeping easier and cheaper. The main weakness of the cash basis is that financial outcomes in any given period may look distorted. Also, cash accounting is not accepted by GAAP. And any financial statement results are considered insufficient by most lenders.